Everyone, we will look at IAS 7 cash flow statement in this video. So every time when we are dealing with cash flow, we will talk about cash and cash equivalent. So the cash flow, or we call it as cash and cash equivalents, represents the cash in our hands or cash at our bank. So the first two very simple things that we always see in our financial accounting papers is these two, cash in hand and cash at bank. And same goes to fixed deposit. Fixed deposit, maybe in finance subject, can be called as a short-term investment. But in this fixed deposit, because they are able to call in demand, therefore, fixed deposit is also considered cash and cash equivalent. Likewise, overdraft bank, the opposite of cash at bank, and any short-term investment that is lesser than 3 months is also known as our cash and cash equivalent. The whole idea in the cash flow statement is that we want to ascertain how much is our cash and cash equivalent. And the answer will be these few items adding up, the net of together. That will be your cash and cash equivalent. So you need to know all these things is the final answer. So over IAS 7 cash flow statement, we have two types of method. Let's look at the left hand side. So we have indirect method, and this cash flow statement we always talk about three categories: operating, investing, and financing. So operating is technically all the routine business activities, the receive and payment that we actually have in our normal business operations. So having just looking at operations itself is insufficient. Therefore, we also want to look at whether we've invest anything or not, because such investment will bring us future cash flow. Like I buy PPE, or I invest further in a long-term investment or any investment more than 3 months, that will be under investing activities. And or any investment that previously I bought it and I decided to divest, meaning to say I want to dispose of. The proceed of the disposal I'm going to report in the investing activities. Likewise, we have financing. Investing is something like we're spending money, most of the example. Financing is where we get money from our shareholders or we borrow from loan holders. So these financing activities, we will getting money or we paid money to service the cost of debts and cost of equity. All that will be categorized under financing activities. So therefore, we will have these three important components for indirect method and direct method, same things. Now, so let's start with the operating activity. Indirect method, this method is the most common method. And indirect method, we will reconcile from our profit to cash flow. What does it mean reconcile? In preparing statement of profit or loss, we are looking at accrual accounting. Accrual accounting means anything that I have performed but I haven't received money, I'm going to record. Any expenses that I actually incurred but I haven't paid, I will record, regardless receive or payment. So meaning to say, in statement of profit or loss, we look at when is the transaction happen. As long as the transaction happen, I don't care whether I have received the money or I've paid the money, I will record that in our SOFP, and this will be form up my operating profit. So that will be a problem, because you know that reported profit doesn't mean you really receive the cash flow. Like for example, I sell a goods to a customer on credit, and I'm going to debit my receivable, credit my sales. It doesn't touch your cash. So therefore, under cash flow statement, this will not be accounted. So all these items, right, we will need to reconcile from operating profit, which is based on SOF, SOPL, and we will need to reconcile some non-cash adjustment. Example, any provisions or accrual of expenses because of the accounting standard or concept, you record that expenses as a provisions, whatever. That provision happened in this year, please add back. Treated like this provision never happened before, because it is a non-cash item. You don't really pay that in that year because of you want to adhere with IAS 37, you met these provisions. Therefore, we add back. Or add back any loss of disposal minus any gain on disposal. Example, I have these calculators worth $100, but I sell other people 150. So when I sell, I receive 150 and the cost is actually 100. The $50 will be reported under profit on disposal, which will impact your operating profit. But to be exact, when you are disposing this item, right, you receive 150 instead of that $50. That $50 is because of accounting, you record it as a profit or gain. Therefore, we need to minus out the gain, or if it is a loss, we will need to add back the loss. So it's a non-cash item. And we will add back our depreciation non-cash item, amortizations, and impairment. Because all this item is originally forming up your operating profit. If you don't understand what I'm trying to say, I'm trying to tell you that normally in SOPL, sales example is 1,000. Maybe we have minus multiple example like depreciations, minus amortizations related to your intangible asset, minus the impairment, and plus any gain on disposal, and you minus your normal expenses, and you get your profit. So this is your operating profit. So example, minus 100 minus 200 minus 300 minus 100 plus 120 minus 400. So you will get the operating profit of 120. But you know that this is an operating profit under SOPL, and this is not your cash flow. In order to reconcile your profit to cash flow, what you're going to do, under IAS 7, when we are using indirect method, we will start off with our operating profit 120, and you know that all this item is non-cash item except for normal expenses. So originally you minus in here, you will need to add back the depreciations, add back the amortizations, add back the impairment, and I minus out the gain on disposal because originally plus. So we will add back, and minus out. So that will be our profit or operating profit before your depreciation, impairment, and the rest of the things. Before depreciations, impairment, and etc. Okay, or after the adjustment. So we are going to stop at 600. So this 600 is what we are intended to find in net profit before working capital changes. So what does it mean before working capital changes? So this, to be exact, is operating profit before working capital changes. So this operating profit before working capital changes, meaning to say the second step we are going to do with some operating changes or working capital changes. So working capital, we got three things: inventory, receivable, and payable. So these are related to your sales, because you have booked in some sales which is based on accrual basis. You need to adjust that. Related to inventory, payable, that is related to your cost of goods sold. So in order to adjust with the item happen in your sales and your cost of goods sold, okay, so that you can get your gross profit in here. So to adjust with the items that hiding inside here as a credit sales or credit purchase item, you are going to adjust with these working capital changes. So we will need to ask ourselves, comparing, question will give you SOFP for both year. You need to compare the movement of inventory, receivable, and payables. So if let's say your inventory is increasing, is your outflow, and your answer will be minus. If let's say your inventory is decreasing, it's a positive amount. So what does it mean increase? Why increase is always negative? Because when you are increasing your inventory, example, last year 100, this year 150, increasing. Meaning to say you buy more stock, put it in your warehouse, and your cash is tied up in the warehouse. Meaning to say you don't have that cash. Therefore, it is an outflow if it is increasing. But if let's say last year 500, this year 200, the stock has reduced. Stock has reduced means what? Going out and I receive cash. So my cash coming back. Therefore, decrease always cash up. Increase always cash down. Likewise to receivable. Receivable increase in receivable is outflow because you are asking your customer, hey, you can pay me later. So pay me later means what? The money is not with us. Therefore, it's an outflow. But if let's say last year 6,000, this year 4,000, so what does it mean? It means that you have chasing the money from your customers. So you receive the money from them. So therefore, if it is a decrease, positive. But bear in mind, liability will be another way around. Liability meaning to say, we owe people money. So if let's say our payable reduce, what does it mean? Last year I owe other people 1,000. This year I owe other people 4,000. Meaning to say, I doesn't owe them so much already. Why I doesn't owe them so much? Because I have paid them money. Cash outflow. Therefore, if it is a decrease, negative outflow. Likewise, if let's say last year I owe 4,000, this year I owe them 6,000, increase already. And in this case, we are going to add our payable because we don't pay other people money at the moment. At the moment, the money is in my hand. I don't want to pay them. So it's a cash inflow. So you need to process, study with understanding with all this logic behind. And that will be your changes in working capitals. And finally, there are three layers under operating activity. First layer is the adjustment. Second layer will be the working capitals. And third layer will be your tax paid. So before the revise of the IAS 7, actually we will need to input our interest in here. But after that, we only put our tax paid under our operating activities. Therefore, we will just minus our tax paid. Cannot be the income tax expenses. Income tax expenses is based on accrual basis. We want to see what is the exact tax that have paid to the income tax. And sometimes can be tax refund. Tax refund means we need to plus because government give us back the money. And your income tax expense sometimes could be hiding the deferred tax implications. So you need to remove it out. Then only you calculate your tax paid. We will look at the example in a short while. So this is operating activities. So if it is a direct method, we are not going to reconcile from operating profit. So under direct method is more towards you need to go and find all the number by yourself. You are not starting from SOPL. So we are going to find how much cash we have received from customer using the T ledger that we learned in FA papers. So we will look at the example later. Any payment to supplier, any payment for operating expenses, any payment to our employees. So all this plus minus all these things, you will get your cash generated from operations. And we will need to minus our tax as well. So that's gonna be our direct method. So if after we have seen the direct method already, let's explore investing activities. So investing activities format will be very direct. You need to find how much is the amount that you purchase from PPE, you purchase of PPE, how much you purchase for intangible asset. Purchase means what? You are investing new PPE, investing new intangible asset, or sometimes could be investing new investment properties. Or sometimes you dispose the old PPE, you receive the money. Or you invest, you get investment income or dividend income. And you minus any increase in long-term investment or increase in short-term investment, and the short-term investment must be more than 3 months. So all that are considered your investing activities because you are spending money hoping that in future all this asset can give you future economic benefit. So same things you are going to see in your in your direct method as well. So until this part, everything will be the same. And finally, financing activities, whether you obtain money from your shareholders or not, whether you obtain any money by issue loan notes, debenture, borrowing or not, whether you have repaid or not. So you have to compare this year and last year to see whether increase or reduce or not. We will look at the example in short while. So all this is getting money from your bank, or you repaid money to your bank. You get financing from your bank. Of course, you need to pay them back money. You pay any interest to service the cost of debts, pay any penalties related to any redemptions of loan because of some penalties, also cost of debts, and you pay dividend, that is a cost of equity. So same things you are going to see in your direct method as well. So same thing, exactly the same things. Then once you're done, you will get your operating net cash flow from net cash flow used by, if there is a negative, and this plus it up together, operating, investing, financing, net it up together, you will get net increase. And you will need to plus with your opening cash and cash equivalent, and net it off, you will get the ending cash and cash equivalent. And this XX ending cash and cash equivalent will be same like the amount in your SOFP under the ending side balance. So that will be your cash and cash equivalent. Likewise, direct method also the same. So that will be the two most common method, direct and indirect methods, when we are doing our cash flow statement. And to better understand this particular IAS 7, now let us look at a simple example so that we can see what are the things that we need to take note. So this question is on preparations of indirect method. And we have been given SOFP for 2 years. 2021 is beginning, 2022 is ending. So we have operating, investing, and financing. So we need to go and find the working first. So operating, let's start with the operating first. Since this is an indirect method, we will need to go through all these steps in these slides. And SOPL, as well as we have some additional information telling you that you have depreciations, amortizations, gain on disposal. Of course, you know that all these are the items that you are going to add back in the starting of your indirect method, because you start with operating profit. So if let's say we are starting with operating profit, meaning to say this amount, operating profit 324, and these three expenses is included in your operating expenses. Note number 1, sorry, this is not number 1. Therefore, all these things we are going to start here, and we will need to add back the depreciations, add back the amortizations, and gain on disposal, we will need to minus it out. Therefore, that will help us to reconcile from our profit back to the non-cash item back to the cash flow. But that is before your working capital changes. And immediately after these steps, immediately we know that we need to add back all these things. We will need to go to the changes in working capital. So the changes in working capital here, we are going to see in here is that, so this is this is not number 1, yep. So immediately after this, we will look at the working capital changes. So working capital changes here, we have inventory, receivable, and payables. So very clear that we can see inventory 1020 last year, and this year 982. So this is a reduce. Reduce meaning to say we are actually selling out the item. So it's an inflow to all of us. Receivable also reduce 760 to 546. Our receivable reduce means we receive money. So it's an inflow, positive. And payable 1173 to 720. So this one is also reduced. Reduce means what? We are paying money. But this one, we are paying money, therefore is our outflow. And this is the working. Can you see? Increase in receivable, positive. Increase in receivable 214, positive. And decrease in payable, negative, because we are paying money. And after that, we need to calculate our tax paid, because once we settle this, we will need to know our tax paid. So the tax paid here a little bit complicated, because you have all this I highlighted in blue color, the income tax expense. And this income tax expense is hiding the impact of deferred tax. Deferred tax reduce, which will be reduce your income tax expenses for this year, because when you are debit your deferred tax liability, you will credit income tax expenses to reduce the expenses. So this is a non-cash item, you will need to take it out. And you have tax payable. Opening, you owe income tax 106, ending you owe income tax 129. So let's calculate our income tax account first. So income tax, we know that our SOPL is 75. And if you're looking at your deferred tax, it is reduced. So reduced, we will debit our deferred tax liability, we will credit income tax expense over here. So therefore, there is a 16,000 has been booked in income tax expense to reduce the current year expenses. And we will need to find our original positions before we minus this reduce in deferred tax income. Now, so moving back here, you know that the original current year tax is 91. So the originally, you calculate your income tax is $91. But because of deferred tax reduced by 16, you debit deferred tax liability and you credit your income tax expense. And you will report 75,000. But this 75,000 is not the correct income tax expenses. So that's why we are trying to use this T account to move backward, exclude it out, to find our 91,000, which is our current year tax for the year. And the second stage, this is also not our tax paid because we have been owing income tax 106 at the beginning and at the end 129. So let's calculate tax payable. At the beginning, we got 106 liability. At the end, we got 129. So this income tax expense, current year tax, right? We will debit our income tax expense, credit tax payable. Because this is your current year tax that you are going to pay. And this will be something that will increase your liability. So if let's say I'm telling you that opening I owe income tax 106, this year you actually need to pay income tax another 91,000, but at the end you owe them 129 only. So the difference will be your tax paid to be reported under your SOCF under this part. So that's why I'm telling you that you need to remove deferred tax liability. So if let's say your deferred tax is increased, your deferred tax increase in deferred tax will be in here. So the remaining portions will be your current year tax and put it under your tax payable. So this is how we are reconciled from the balances in your SOPL, SOFP back to the cash flow, the exact cash payment that we made. So this is on operating activities. Second part will be on investing activity where we need to find our purchase of PPE. So NCA is a good signal. You can look at NCA. PPE, you purchase PPE, you purchase long-term investment, you purchase intangible asset, and you got short-term investment. So short-term investment refer to notes number 1. Short-term investment is 6 months. Okay, let's go back to here. 6 months short-term investment. So therefore, if let's say this is a 6 month short-term investment, this is a 6 month short-term investment, right? Therefore, we know it is more than 3 months. So it's our long-term, is actually considered as our investing activity because according to IAS 7, if it is a short-term investment, less than 3 months. Therefore, this one, you have to put it under investing activity rather than treat it as the final answer of your cash flow statement. So if it is a lesser than 3 months, you don't need to do anything. That particular short-term investment will be reflected in here already because it's part of the cash flow. So with that, let us start with a simple one. Before that, question also tell you got depreciation, amortization, gain on disposal, and question also tell you a machine with a carrying value, which is the net book value is 324, you dispose for cash and you make a gain of 28. So you need to calculate how much is the proceed of disposal. And you got a cost of dismantling. So this one will going back to your IAS 16. So cost of dismantling is the initial cost of your PPE, where you will need to estimate a future value of how much is the cost of removal. You bring it back to the present value, then you debit PPE, credit your provisions. So it will increase your PPE. And unwinding interest related to this cost of dismantling, and there's an purchase acquisitions of the intangible asset software during the year. So all this highlighted, something that I highlighted in here, you're going to use in investing activities. Let us start with a simple one. Short-term investment. So since more than 3 months is your investing activity. So last year 110, this year 184. Therefore, increase by 74 is the investment. Because increase already, meaning to say you spend money. So the next one, proceed of disposal. Can you see in here, we are trying to tell you that the book value is 924, meaning to say 324, meaning to say this asset worth 324. But I made a gain of 28 by disposing it. So 28 is in 1,000. So please bear in mind. So 324 plus 28, you know that your selling price is 352. Therefore, that will be your proceed of disposal. So this is something that you need to think a little bit. If it is a loss, then you need to minus that net amount will be your proceed you receive from your customers. Then working number 5, acquisitions of long-term investment, also something that is straightforward. Last year 250, this year 348. Increase, so it is an outflow, 8,000. And after we do the simple one, now we are looking at PPE and intangible asset. Let's start with the difficult one in PPE. So PPE, let's prepare our PPE account so that we can better understand how much money that we have spent. So our PPE at the beginning is, you cannot just compare 1880 with 2650 because PPE got depreciations, PPE also got revaluation surplus, and PPE also got cost of dismantling. So the revaluations, sometimes question won't give you in here, and you use your calculator and find it out in your revaluation result. From 45 increase to 213. So 45 increase to 213 increased by 78. So this increase is an indicator that your PPE has been increased by revaluation surplus. So all these items will be impact your calculations. It's not just compared like this, because short-term investment and long-term investment doesn't have any depreciation in here. So PPE, opening 1880, closing 2650. And we have our depreciations, which is reduce your PPE. And we have our disposal. This amount is the net book value after depreciations, the accumulated depreciations that will be kicked out from your PPE account. Therefore, credit side of your PPE. And you got revaluation surplus, which is 78. So the balance will be in here, which is your purchase of PPE, the amount of cash that you paid to buy this PPE. So obviously, credit side larger. There's a cost of dismantling, 300,000. This will also something that has been recorded to increase your PPE in this year. So obviously, credit side larger, you move it into debit side, minus of these 3 items. You will get your purchase of PPE. And this is the real amount that we have used money to pay PPE. So PPE amount, we got it already. So technically, we are using our FA knowledge to go backward and find the cash flow. And finally, intangible asset. So opening, we don't have anything. Closing, we have 274. But we know that we have amortizations of intangible asset 86. So this 86 will be the only amount. Put it here, 360 plus it up, and move here. So you actually buy intangible asset in the year by 360. So all this will be the working for you to put it under investing activity in a short while. Short-term investment is a negative. Proceed of disposal, you receive money, positive. Acquisitions of long-term investment is negative. You buy PPE is negative. and you acquired new intangible asset, also negative. So after we settled our investing activity over here, we will look at our financing activity. Typically, you can always remember we have few common we have few common items: ordinary share, loan, interest, and also your dividend. These four are the most common one. You need to find out these four items. So on our ordinary share, very straightforward, 600 increased to 1151. Therefore, there's an increase by 551 issuance of ordinary share. You get money from your shareholders. Loan notes from nothing to 257, meaning to say you borrow money from bank by 257. And we need to find our interest paid. We will need to use our T account to find it out. Again, finance cost over note number 4, they say there's an unwinding discount 30,000 being included in the finance cost. Because just now when you are trying to book in your cost of dismantling, debit PPE, credit your provision, your present value, meaning to say your future value maybe is 400k, and you are trying to bring it into present value 300k. So that is maybe in 1st of January 20x0. But after 1 year, 31st December 20x0, you need to unwind, bring this present value to that after 1 year future value. So that will be a process of unwinding interest. So this unwinding interest 30,000 has been included in the finance cost. And in your interest payable, opening 65, closing 55. So all this yellow color that I highlighted will be impact your interest paid calculation. So opening 65, closing 55. And by right, the finance cost without the unwinding effect, 80,000 will be put it over here. Because debit expenses, credit your interest payable. But you know this 80,000 includes 30,000, which is unwinding interest cost. Unwinding interest is something that you didn't involve any cash payment. So we need to minus out. 80 minus 30, you will get 50. Therefore, net amount minus 55, you will get interest paid. And 60,000 interest paid, negative. Finally, we will need to find our cost of equity, which is our dividend. So dividend, we look at our retained earning, profit, and retained earning closing. And this question is so special, they got dividend payable, meaning to say you are not directly paying dividend after you declare. So if let's say at the beginning I have 1621 dividend retained earning, this year I earn 209 profit. By right, 1621 plus 209 should be the ending. But the ending is at 1799. Every single year profit will be transferred to retained earning. This is what we know because of asset equals to liability plus equity plus revenue minus expenses. So we know that over here, 1621 plus 209, you know that your ending will be 1830, and the 1830 will be transferred to here and minus your 1799. That will be your 31,000, which is your dividend. So this dividend, by right, if question didn't give you dividend payable, this is the final amount to be put it under your cash flow statement because you paid this dividend. But question tells you you declare this dividend and you don't pay directly. You got dividend payable. So it means that dividend for the year 47, ending 31. This dividend 31, you are going to transfer to dividend payable because you owe money. You don't debit retained earning, credit cash. You debit retained earning, credit your dividend payable. And 47 plus 31 will get 78. 78 over here, the remaining 47 will be the actual dividend that you paid to be transferred to your financing activities. So this is some simple steps that you need to recall back from your financial accounting papers. So with all these 11 working that we have well prepared, we will need to transfer into our cash flow statement. And this cash flow statement, we will start off with our operating profit, adjust with the non-cash item, minus or plus any changes in working capitals, and we only minus tax paid, then you will get the net cash from operating. After that, those investment amounts, such as you buy short-term investment, you receive investment income, you dispose the properties or machine, then you receive the money, and you buy long-term asset, buy PPE, buy intangible asset, that buying will be an outflow. So net cash used for investing activities. And you invest is for future economic benefit. And you need money to support your investment. You actually get money from your ordinary shareholder, you get money from borrowing, and you need to pay interest, and you need to pay dividend. So the net amount will be your financing cash flow. So net it off, 42. Cash and cash equivalent as per the 1st April 2021 will be negative 12. Why 70 minus 22? 82. Let's look at the statement here. You have your cash flow under current asset, cash at bank, and you also got overdraft. So 70 minus 82, that will be your cash outflow, so-called the negative balance. And your answer must be equals to 54. So let's look at our answer. Our answer is 54. Therefore, it's correct. So this is the cash at bank minus our overdraft bank. Then you will get a negative 12. So overall, the positions of this company is not doing good because they are recording a negative balances. So this is indirect method. So what about direct method? If direct method, question will be slightly different in the sense of operating parts. So we have all this SOFP and SOPL, and we have the additional informations given in here. Let's look at it one by one. So over our direct method, question will be a little bit different in the sense of operating activity again. There are few items that you need to find: cash received from customer, cash paid to supplier, cash paid to operating expenses, cash paid for employees, and tax paid. So we will need to go and find it out with all this figure, something that we learn in FA, a little bit fundamental knowledge skill you need to have in here, through using receivable account. So like your control account of receivable, we will use this account to find how much is the cash we receive from our customer. So looking at your receivable, opening 8165 asset debit side, and your balance carry forward 7216 move forward will be in debit side as well. So this is your receivable, and in this year you have recorded your sales, which is 333980. You credit sales, you debit receivable. Therefore, you know that something is putting in here to reduce your receivable. That is the amount that you have intended to find, which is the cash received. So if you're adding this, put it here, minus 7216, the balancing amount will be your cash received from your receivable. So this is gonna be the amount to be put it over your direct method, cash received from customer. So that is just like that. And we have our supplier, will be complicated a bit. So if you look at our supplier tax payable, trade payable 13041 and 10644. By right, I know I got a purchase in here. But if you look at your SOPL, we don't have purchase. So if you don't have purchase, we will need to use cost of sales and the inventory to find out our cost of purchase. How to do that? Your opening inventory, closing inventory. So inventory reduced is because you send the stock out. And if you send the stock out, meaning to say the sales happened in this year. And that cost related to the sales, we call it as cost of sales. You will credit inventory because stock go out, and you will debit as an expenses under cost of goods sold. Therefore, you reported 290820 in SOPL. So what is something that reflect in the debit side of inventory. Must be you buying inventory. Therefore, move backward, minus 10175. You know, this year you have buy 288865 purchase of inventory. And this amount will be the amount in here. And you use opening payable plus whatever credit purchase that you make. We assume everything credit purchase. Move here, minus closing balance. You know that this balancing will be the cash paid to your supplier. Cash paid to your supplier over this part. So actually, again, is using the FA knowledge. And working number 3, we will need to find our cash paid to employees, where additional information number 1, they say staff cost by department as follow. You pay distribution department 2530, administration department 2120. Therefore, total up, that will be the cash paid to employee. And if you look at another additional informations, they say administration expenses for the year include impairment loss, non-cash item, depreciation, non-cash item, loss of disposal, non-cash item. So the next step, we are going to find our cash paid to operating expenses. So when we want to calculate cash paid to operating expenses, we know that our operating expenses in here is distribution costs and administration costs. And we cannot directly plus together that, consider it as our cash payment to other expenses. Because in note 1 and 2, they say, note 1, staff cost. Staff cost you need to minus out because you have specially present in working number 3. And Roman 2 additional information you need to minus out because it is non-cash item. And you will get 8140. And finally, tax paid. So tax paid will be like what we did just now in the indirect method. So our tax payable will be 4210, closing 3308. And we have our income tax expense 5020. You cannot put it directly in here because you have increase in deferred tax. In this case, it is increased. Just now it's reduced. Increase in deferred tax will increase your income tax expense. You need to remove it out. So, your current year tax, to be exact, minus out your deferred tax increase. So 5020 minus the increase of deferred tax, which is 231, you get a net 4789. That will be the actual tax paid. That will be your actual tax expenses during the year, not tax paid. So you will put this over credit side of the tax payable, and you plus it up, minus balance, you will get the actual tax paid. So that will be your tax paid reported under your direct method here. Doing the same things for investing and financing. So in this question, we have our impairment loss, depreciation, loss of disposal. And there was a disposal of plant, carrying amount is 5.2 million. So the value is 5.2, but you sell at a loss of 1,002. So you need to minus out to find your proceed of disposal. If sell at a gain, you need to plus out to see the selling price. So your working 6 proceed of disposal will be 5.2 minus 1.2 million. You know that you sell at 4,000, you sell at a loss. This is your proceed of disposal. Put it as a positive under investing activities. This question, you got PPE and investment property as well. I tell you already, this is your hints. And a short-term investment, in here, we assume it is a less than 3 months. So we will put it under our cash flow. So our PPE will be opening 120091, closing 127. We know depreciation is 3250, impairment 1800, and the disposal carrying amount go up from the business is 5,200. Let's check whether we got revaluation gain or not. Yes, we have. So 5,004. And with that, plus it up, minus, you will get your purchase of PPE. That will be your investment. And your investment property opening and closing, you got a fair value loss. So under IAS 40, they are using fair value model. So fair value loss will reduce in this side, plus it up, minus, you know that the net amount in the debit side is you buy investment property, you pay. So 6244. And we were ending up with our financing activity. So financing activity, again, you need to ask yourself 4 things. How much money we receive from share, how much money we receive or pay our loan, how much money we pay interest, and how much money we pay our dividend. So in here, let's start off with our ordinary share. So it's an increase by 12559. Let's look at our loan. Loan is reduced. Reduced meant repayment. So you need to take note on the wording that you use, repay. So you borrow money, you need to pay money. In this case, it's pay money lah, because reduce. So reduce by 10655. And working 11, interest paid. There's no interest payable in current liability. Can you see? Therefore, in this case, we will just treat the interest expense 3420 as our interest paid. If let's say there is an interest payable, you need to work out the interest payable account to find out how much is the interest paid, because they don't pay interest on the spot. Dividend. So this question also very clear cut because they don't have dividend payable. So we will just take our retained earning opening, closing. Our profit will be put it under retained earning. So plus it up, put it here, minus, you will get your dividend paid. So this is your payment of dividend straight away because you don't have dividend payable. So you can observe your current liability and to anticipate what is the working that you are going to do in the next steps. And this question, we will do one quick working that we didn't do in the illustration number 1, because we have this 3 blue color cash flow. So these 3 blue color are cash and cash equivalent. So we have short-term investment, cash at bank, and we have overdraft bank. So you use your asset minus your liability overdraft bank. This will be your opening cash and cash equivalents. For the ending, just these 2 assets, short-term investment and cash at bank, that will be your only cash, your ending answer of your cash flow statement, 13322. So our answer must be equals to 13322 in our cash flow statement. With this 13 working, let's prepare our cash flow statement. So this cash flow statement, very clear cut. We can see we will need to prepare our operating cash flow. So operating cash flow, start off with our cash received from customer, cash paid to supplier, cash paid to employees, cash paid to operating expenses, minus tax. You get your first layer, operating activities. Investing, we have disposal proceed, buy PPE, buy IP, net cash spent in the investing activities. And we receive money from shares issuance. We paid money because of the loan payable. If payable, negative. If you get money from bank, it's a positive. So please take note, increase or reduce. Dividend payable, paid, and your interest payable. And net of it will be cash spent in financing. Net it off, increase. Looking at your working 13, just now we calculate the cash and cash equivalent. So plus it up, we will get 13,322 ending cash like what we did just now. So in short, cash flow statement actually is quite systematic. We are building on our financial accounting knowledge or the T ledger and move backward to find out what is the cash flow at each of the line item under the format of statement of cash flow. So with that, I've ended my IAS 7. I hope you learned something. If you enjoyed my video, do share to your friend and subscribe the channels for more information on accounting international standard. Thank you and see you in the next video.